Hey, Money Guy family, it's your host, Brian Preston, with Mr. Bo Hansen, back with another episode of Ask the Money Guy.
That's right. You guys have financial questions. We've got your financial answers. Go out to our website, moneyguy.com, and you can ask us a question, or you can go out to your favorite social, use the hashtag #AskTheMoneyGuy, or you can leave a comment in the comments below.
It's Brian Preston, the Money Guy.
Brian, today's question actually came directly through email, and this is from Jackson. And Jackson wrote a wonderful email, and it was very long. I'm going to pull out one small segment of it because I think it's so great. This is what Jackson said. He said, "Hey, I'm 23, in a serious relationship, planning on getting engaged soon. Congratulations. I didn't say your last name just in case your girlfriend listens. I know my girlfriend has around $40,000 in student loan debt and is graduating from nursing school this summer. I have no debt and about $20,000 in savings. Should we put all of our resources and effort into getting rid of that debt right away if we get married, or just make the minimum payments and follow your order of operations?" So his big question is, I'm marrying it for my wedding present for my wife. She's bringing some debt. What should we do? How should we handle that?
So I love this question because this actually sparked us having quite a few discussions in our pre-show planning. I love this question because it spurred some unique conversations for us in pre-show planning. Because my dad and mother used to share the story that before my dad had told my mom, "I want to marry you. We're going to get married, but you got to get some of these credit cards and other things cleaned up before we can do it."
Right.
So they had a discussion. So that's my first thing when I get a question like this. Who asked? What's
This
his
is
name?
from Jackson.
When Jackson asks a question like this, the first thing, this is a discussion you have before marriage. It's kind of, the big ones are religion, kids, and then debt.
Yeah, that's right.
So definitely have this discussion before marriage. And if you determine, okay, yes, she has some student loan debt. I love this woman. I think this is something we can overcome. And I think you need to approach it together.
That's right. I think when it comes to laying out how should we best proceed, that's not something that Brian and I are going to be able to answer for you. That's something that you and your soon-to-be fiance, soon-to-be wife need to sit down. And you need to figure out what are your joint goals as a couple. You individually may be very averse to debt, but she may say, "Hey, I really want to start building wealth. I really want to follow the order of operations." You guys have to figure out where your priority lies as a couple and make sure you're on the same page there to start with.
And remember what I've always talked about. If you are the financially minded person, if you're going to get there, create that collaborative environment, create a written joint plan that helps you guys know what the priorities are so you can practice that forced scarcity at the beginning of the marriage so that you can give her a vision, him or her a vision for what the future will look like as well. That's going to create a lot of purpose and also a lot of buy-in.
And I think this, again, now this is personal advice. We're stepping a little bit away from, like academia. This is more just personal in my experience. When my wife and I got married, she came into the marriage with student loan debt. And what I told her when we got married.
So you resemble this question.
I resemble this question a lot. And I said, "Sweetheart, when we become married, it's no longer your debt, it's our debt. What's mine is mine and what's yours is yours." And it was really helpful for her to hear that, for her to know that this wasn't some burden that she was bringing in. Once we got married, once we became one, it was now our debt. And we were going to talk about how we handle that together. I think it's important if you want to have constructive conversations around that, when you do make the decision to join up, you recognize, that's not some bear that she brought in and she's got to deal with. It's now ours. We own it. We have to work through it.
So let's talk about order of operations. We talk about financial order of operations, just like math problems don't work unless you do them in this certain order. Your finances are the exact same thing. It's crazy that people don't get that concept that finances have a ton of math components, so you better get the order of operations right. So we did a slide on a show on healthy relationships with debt, and we did one specifically on this, and it actually had some guidance. So if we pull this up, here's what I think I like about it. It gives you, and I'm going to let Bo go into greater detail, but the setup for it is we have different age groups there. And you'll notice we have 20 to 29-year-olds, 30 to 39-year-olds, and 40 to 49-year-olds. And a lot of this, you'll notice return of loans that you need to prioritize if your interest rate's over these thresholds. A lot of this was built off of an understanding, and this is why I'm going to let Bo kind of jump in, risk-free rate of return and equity risk premium How did this, give me the layout for this slide, bro.
Yeah, so the thought is that whenever you invest, you're taking on some risk, and in exchange for the risk that you're taking on, you get paid a premium, a rate of return above what the risk-free rate would be. And we know
Which
that
is kind of like you could make, let's just say your savings, because
Yours-
that's not what the risk-free rate, but it is very similar.
that's
Treasuries.
exactly right. And so we know that if we're going to be compensated for taking additional risk, that's probably going to change through time. So we know that when we are young, we can be more aggressive, and when we're more aggressive, generally speaking, there's a higher rate of return associated with that. Well, as we age, as we move from our 20s to our 30s, 30s to 40s, 40s to 50s, our expected rate of return should decrease. Said a little bit differently, our risk premium shrinks a little bit.
Yep.
So we just decided mathematically, based on historical averages, if you're in your 20s and your student loan debt is above 6%, you should probably prioritize paying it off. If you're in your 30s and your student loan debt is above 5%, you should probably prioritize paying it off. And then once you get into your 40s, if your student loan debt is above 4%, you should probably prioritize paying it off. If at any point in time your student loan debt is below those numbers, there's a likelihood you would be better served by investing those dollars, letting your army of dollar bills grow for the long term, taking advantage of that equity risk premium.
And then I recently had somebody reach out and says, oh my gosh, I'm in my 50s. I still have some student loan debt. I was like, get it prioritized.
Get it
You
done.
should be trying to be debt-free on everything. I don't care if it's mortgage debt, student loan debt. You want to be completely debt-free as you're quickly approaching financial independence, because there is financial independence does not, it just doesn't work well with encumbrances. That's what they do. They steal your opportunity to have independence. So if you can understand that, I think it is be a great building block foundation discussion to have with his soon-to-be fiance.
Jackson, this was an awesome question from the Money Guy team. Congratulations. Marriage is awesome. You're going to love it. Exciting to hear how you guys build a life together. If you guys have a financial question, you can reach out to us. You can go to your favorite social, use the hashtag #AskTheMoneyGuy. You can leave a comment in the comments below, or you can go to our website, moneyguy.com.
Money Guy team, out.